Good evening, students. Welcome to another session of question paper solving from Ekcel Academy. So we will be looking at CMA question paper, the one which we had left off yesterday. This is the December 2019 question paper which we are solving. Right now we have solved 75 questions. This would be the 76th question and onwards. Let's try to wind it up today so that we can take up another paper in the next session, which will be next week, because the next live session after this will be question paper solving of FM subject. Okay, let's look at question number 76. Let's try to read the question first. A theory question, a simple one. Which of the following is not a step taken towards implementing an effective management reporting program? Which of the following is not a step, they say? See, the steps taken towards implementing an effective management program or reporting program would be like what? Discovery. So this involves what? Identifying the business problems that need to be solved and the business drivers that will provide momentum and justification for the implementation. So therefore discovery is anyway already a point in the program. That is something which we have to take up. Then we'll have the access point. This involves determining how users will access the reports, such as through maybe website or mobile app or whatnot. So that is also there. Then there is feedback mechanism also, wherein we need to constantly get the feedback from the user so as to improve the reports and overall reporting system. So therefore financing is not a step taken towards the implementation of an effective management reporting program. So therefore the correct answer in this case would be finance. Moving on, question number 77. I hope the voice is clear, the video is clear. If at all there is any issue with the voice or video, please do let me know. I have increased the volume considerably from the previous session anyway. Next, a low margin of safety usually indicates what? Okay. Margin of safety is nothing but the difference between BEP sales and the actual sales. If say my BEP sales is 75,000 units and actual sales is 1 lakh units, the margin of safety in this case would be 25,000 units. If at all there is low margin of safety, it usually indicates that a company has high fixed overheads. That means a company has a lot of costs that do not change with the level of output. Which is that cost which does not change with the level of output? That would be the fixed overheads. So as a result, the company needs to generate a lot of sales in order to cover its costs and make some profit. If the sales falls, the company is at a risk of incurring loss. Whereas if a company had a high margin of safety, it only indicates that the company has low fixed overheads. That means the company has a lot of costs that actually change with the level of output. That means more or less everything is variable. It's not fixed. So as a result, in such cases, the company need not actually generate as many sales in order to cover its cost. See, if there is so much of fixed cost, I have to first cover that fixed cost. No, until I cover that fixed cost, there is no question of even earning anything. So that is the thing. So therefore, in this case, the correct option would be high fixed overheads. Let's move on to the next one. 78. Which of the following is not a method of transfer pricing? Okay. Considered in normal course, they say. Full cost transfer pricing, negotiated transfer pricing, opportunity cost transfer pricing, standard cost transfer pricing. Okay, there are various options. See, again, this depends completely on your knowledge. If you know already, then you can easily answer this in the exam. You can't be thinking here. So let me just tell you briefly what is what. Full cost transfer pricing is where the transfer price is set to equal to the full cost of producing the goods or services. So that is there. Then negotiated transfer pricing means where the transfer price is negotiated between two companies involved in the transaction. Then we have what? Opportunity cost transfer pricing. Then there is something else also known as market based transfer pricing, but the real answer here would be the standard cost transfer pricing, because it is not a method of transfer pricing considered in the normal course, I would say, because standard costs are not always accurate representation of the actual cost. We may have some standard, But does it mean that that would be the actual cost of producing the goods or services? Obviously not. So as a result, using standard costs to set the transfer prices can lead to, what can I say, inaccurate financial reporting, and even may distort the performance of let's say different divisions within a company. So therefore the right answer in this case would be option D. Let's move on to a practical problem finally. Ahoratra says hello Ahoratra. Let's move on. Following data provided by M Limited. Okay, we have two different time periods. Whenever we have two different time periods, we can easily calculate the PV ratio using the delta formula. So what we, I mean, if you have studied, you would know delta profit by delta sales, or change in profit by change in sales into 100 will give us the PV ratio. For example, in this case, we have profit for the first 6 months and profit for the last 6 months. So that means there is some kind of change in the sales. But the problem here is they have not given the sales value. What they have given is the cost of sales. What we know though is sales is nothing but cost of sales, like how much did we incur to produce whatever and sell, plus profit percentage. Once you add the profit percentage to the cost of sales, what you get is the sales itself. So therefore in case of first 6 months, so sales would be 70 lakhs plus 10 lakhs, which is 80 lakhs. Cost of sales plus profit. For the second 6 months, the sales would be how much is this? 76 lakhs plus 14 lakhs, which would be 90 lakhs. So that means first half 80 lakhs, second half 90 lakhs. So that is the thing. So now the PV ratio can be easily identified, because what is that they have asked? Fixed cost for the year. For us to find out the fixed cost, we should be able to find out the variable cost as well. For variable cost, we need the PV ratio formula. How to identify the PV ratio formula when two different time frames are given? Very simple. PV ratio is nothing but delta profit divided by delta sales into 100. So delta means change in profit, change in sales. We know now because we have the data anyway. How much is the profit change? If you can notice here, 14 lakhs and 10 lakhs. How much is the difference change? 4 lakhs. 14 minus 10, 4. So how much is the change in sales? 80 and 90. 90 minus 80 would be 10 lakhs. So this into 100, which is nothing but 40%. We don't even have to calculate that. So 40% is the PV ratio, profit volume ratio. That means the contribution ratio. If 100 is my sales, PV ratio, if it says 40%, then contribution would be 40%. Then what about the difference? The difference 60% is nothing but variable cost. So that is how we identify the variable cost here. Now we have identified the variable cost. All that we need to do is find out the fixed cost. That is actually easy after having done this. Now let me consider the entire year's figure. For example, sales for the entire year would be how much? Total sales. We have already calculated the first 6 months sales. No, first 6 months, last 6 months 80, last 6 months 90. So 80 plus 90 would be 170. That means 1 crore 70 lakhs. Okay, minus the variable cost for the year. Variable cost percentage also we have identified, which is 60%. So sales for the year 170 and variable cost at 60%. So we'll have to do the math here. 170 into 60% will be 1 crore and 2 lakhs. So 1 crore 2 lakhs, if you remove that, you will be left with 68 lakhs. So 68 lakhs is what? Our contribution. Okay, let me just write this contribution. Now we know for a fact that contribution minus fixed cost will be profit, but we know the profit total 10 lakhs for the first 6 months and 14 lakhs for the second 6 months. So 10 lakhs plus 14 would be 24 lakhs. So we have the contribution, we have the profit. What is that we do not have is only the fixed cost. 68 minus x is 24. So this will be nothing but 44 lakhs. So which is the right option here? Option D. I hope it makes sense. If you have any doubts, please do ask. So moving on, question number 80. Okay, which of the following are examples of key factors? Okay, they have given the, like this, select the correct answer from the options given below. 1, 3, 5, 6, 1, 2, 4. Okay. Let's try to identify the key factors here first, as it is, without looking at the options only. Sales quantity is a key factor. Okay, then raw material is a key factor, quantity not quality. Quality cannot be a key factor. Labor hours availability will be a key factor. Then plant capacity is also a key factor. Number of plants used in the manufacturing process, no. Cost of production, no. So which are those? 1, 2, 4, 5. Regarding the key factor concept itself, please check the last video, the previous one, where we have actually explained what exactly is key factor. So 1, 2, 4, 5, option B is in fact the right answer. Let's move on. Okay, again we have something similar, which is like match the following here. Okay, fine. So here we have to match profit earned, classification of cost into fixed and variable with the respective definitions. Okay, let me just write down profit earned. What is profit earned now? Contribution, no, contribution is not profit earned. Margin of safety into PV ratio is in fact the formula for profit earned. Again, if you have studied the marginal costing, then you will know all these formulas. So this is nothing but memory, that's all. So profit earned among the options is margin of safety multiplied by PV ratio. That will tell us how much is the profit earned. So that was about P. Q is about classification of costs into fixed and variable cost. So where do we classify cost into fixed and variable? In which concept? Now we have contribution, margin of safety, marginal costing and absorption costing. Just now I studied, I told that if you have studied marginal costing, you will know what is what. So this classification of cost into fixed cost and variable cost happens where? It happens in marginal costing. So marginal costing is that branch of costing where we study this. Okay, so that is done. Then we have both fixed and variable costs are charged to profit. Charged to product. So this happens in case of absorption costing. So that is also done. And lastly, we are left with sum of fixed cost and profit. We have already seen here sum of fixed cost and profit would be contribution. So therefore fixed cost plus profit would be contribution. That's it. So P is 3 and Q is P is not 3, P is 2. This will be P, this will be Q, then R is 4 and S is 1. That's all. I don't know which option is correct now. P is 2, Q is 3 and R 4, S 1. Option B is in fact the right answer. Moving on. Question number 82. Let's see what exactly we have in store here. So again a practical question. Good. Information provided by S Limited are given below. Okay. Fixed cost, profit, break-even point. When sales are 120 lakhs, then calculate the profit. Okay, again this is based on marginal costing. If you know marginal costing, this is actually very easy. Okay, let us try to understand this. Now sales 60 lakhs, break-even point sales. I'm considering the BP sales at BP. Okay, less variable cost would be contribution. We do not know either. Minus fixed cost, that is contribution minus fixed cost, will be the profit. And we know in case of break-even point there won't be any profit or loss, so therefore profit here is 0. How much is the fixed cost according to the problem? Fixed cost is 24 lakhs. So if from the contribution, if you deduct fixed cost, if it is resulting in 0 profit, obviously contribution should also be 24 lakhs. So now if contribution is 24 lakhs after deducting variable cost from sales, then how much would be variable cost? So 60 minus something is 24. Obviously the remaining amount is 36 lakhs. This is a balancing figure. So now what did we find out? We found out how much is the contribution, how much is the variable cost using the BP sales data, because FC was anyway given. So now what is that we need to find out? We have to find out the profit volume ratio. Okay, so this profit volume ratio is nothing but contribution by sales into 100, so which will be 24 lakhs by 60 lakhs into 100. So how much is this? 24 by 60 percentage 40%. Okay, so now that we have found out, now we can easily answer the question which they've asked. When sales are 120 lakhs, then what would be the profit? So that is easily done. I'll just write down here, sales 120 lakhs, then sales into 60%, so that would be 72 lakhs. See, if profit is 40%, obviously variable cost would be 60%. So therefore directly I calculated variable cost at 60% of sales. So remaining would be 40%, which would be 48 lakhs. That would be the contribution. Fixed cost won't change, so therefore it will remain as it is, 24 lakhs. And lastly, profit would be, sorry, not 0, 24 lakhs again. So option C is in fact the right answer. I hope it is clear. If you have any doubts, please do ask. Moving on. Okay, theory question 83. In an activity-based costing system, the allocation basis that are used for applying the costs to services or procedures are called. This is a very easy answer. If you have studied activity-based costing theory, it's actually, there is no practical part of activity-based costing in our syllabus, and the right answer in this case is cost driver. What is cost driver? Cost driver is nothing but a factor that causes a change in the cost of an activity. In ABC, that is activity-based costing, cost drivers are used to allocate costs or products or services. Some examples which I can think of with respect to cost drivers would be, let's say, number of units produced, number of machine hours used, number of laborers. All these are cost drivers. Number of units, number of machine hours, number of laborers, number of material used, raw material used. So what is the advantage? See, by identifying and measuring the cost drivers, companies can more accurately allocate costs to products or services. This can in fact help companies to make better decisions about pricing, product mix, and other business issues. So that is about the cost driver here. Let's move on. Question number 84. Let's see what exactly we have in store here. Inspection of products is an example of unit level activities, batch level activities, product level activities, facility level activities. Again, this is also based on fact. If you know, you know, otherwise you won't know. Okay, in the exam, when you get such type of questions, if you do not know anything about it, I would suggest please don't attempt. If you attempt and if you go wrong, then unnecessarily you lose minus 0.25. In which case should you attempt in spite of knowing nothing? When you are confident about 80% of the questions, then you can attempt the remaining 20 questions. Doesn't really matter. Even if all the 20 questions are wrong also, you'll only lose 5 marks. No, doesn't matter. Anyway, so now in this case, the correct answer is in fact the batch level activities. See, inspection of products is an example of this, because this is performed on batch of products at a time. Batch level of activities are that activities that are performed on a group of products or services at the same time. So some other examples of batch level activities could be setting up of machines, quality control testing, materials handling. All these are batch level activities along with the, along with the inspection. Okay, so that is what it is. Next, which of the following is not a valuation approach? Asset approach, income approach, expenditure approach, market approach. Okay, this is obviously not an valuation approach. No one uses expenditure approach. There is no such thing, because the three main approaches to valuation are asset, income, and market approach. See, asset approach does what? It looks at the value of the assets that a company owns. Then income approach does what? It looks at the amount of income that the company can generate or the company has been generating. Then the market approach looks at the value of let's say similar companies or assets that have been sold in the market. Maybe there is some other company which is of same nature, then we'll look at the value of that company. So there is no such thing as expenditure approach. So that is not an approach for valuation. So that was about question 85. Option C is in fact the right answer. Moving on to a practical problem. Okay. Fine, let's see. Okay, it says YouTube is not receiving enough video to maintain smooth streaming. I hope there is no issue. If you are currently watching the stream, please do let me know if there is any issue. Sometimes the YouTube app itself is unreliable. Unnecessarily I get these type of messages. I think it's fine. Let me just open my YouTube app on the phone and check if there is any issue here. As far as I know, there is nothing much. Okay, it's fine actually. I could see here. Fine, let's move on. Next, a deposit to be made on Jan 1st, 2020 into bank that will earn an interest of 7% compounded annually. A deposit is to be made on Jan 1st, 2020 into a bank that will earn an interest of 7% compounded annually. Fine. It is desired to withdraw rupees 60,000 on 31st December 2023, 160,000, and 1 lakh again on 31st December 2025. See, they want to withdraw twice. So the amount to be deposited now, see, you will deposit today. Let's assume that today is Jan 1st, 2020. Some amount, X amount, we do not know how much it is. Okay. So now this fellow, whoever is depositing, they want to withdraw on 31st December 2023, how much? 60,000. And at the same time, he also wants to withdraw on 31st December 2025, 1 lakh rupees. They have given the present value factor, they have given the interest rate, everything. So considering all that, how much should he invest today so that he can do this, that is withdraw twice, once in 2023, once again in 2025. That's all. Again, not very difficult if you know the formula. Present value, how to calculate the present value? Very simple. Future value, whatever it is, since it is given, into present value factor based on rate and years. So now there are two things here. Once he has to withdraw 60,000, once again he has to withdraw 1 lakh. We will look at one at a time. So present value of that. So 60,000 is the future value multiplied by present value of annuity factor. So now 60,000 means after 3 years, no, 3 or 4, 1st January to 31st December 2023, that means 4 years, because he is depositing in the beginning of the year and withdrawing at the end of the year. So therefore 4 years. Okay, 20, 21, 22, 23. So now present value factor of 7% for 4 years is 0.7629. So multiply that by 0.7629. So when you do that, you will get the present value of that 60,000. That means if I deposit that amount, after 3 or 4 years, I will get 60,000 at the rate of 7%. So therefore 60,000 into 0.7629 equals 45,774. That is the thing. That is one thing, because we have one more thing as well, that is 1 lakh. How much should he deposit today so as to withdraw 1 lakh after 4, 5 years? How many years? 6 years. Yeah. So same thing again, present value equals future value into present value annuity factor. Okay. Future value we know 1 lakh. Present value annuity factor at the rate of 7% for 6 years is given 0.6663, 0.6663. When you do that, you will get 66,630. So when you add this, you will get the amount which he has to deposit today, that is on Jan 1st, 2020, so as to withdraw 60,000 after 4 years and 1 lakh after 6 years. That's it. So that would be this plus 66,630. 1,12,404 is the answer. Option B. Done. I hope it is clear. Okay, bigger fish. Okay. Has a question, sir. I am in class 11. Can I clear CS after class 12? Okay, I think you mean whether you can take up CS after class 12. Yes, you can. In fact, all that you need to do is take up the entrance exam known as CSEET. Once you clear that entrance exam, you will be eligible to write the executive along with your degree. I would suggest please visit the icsi.edu website. You will get all the details. But in short, the answer to your question is yes. Next one, 86 done, no? 87. This is a question which I did not understand. Actually, it somehow is fishy since after I read the answer. Anyway, cost of sales minus selling and distribution overhead plus closing stock of finished goods minus opening stock of finished goods is, initially when I read this, I thought it is cost of goods sold when I looked at the options, but then I realized according to the guideline answers, it is cost of production. Okay, because usually what do we say is cost of goods sold? Cost of sales minus selling and distribution overhead plus closing stock of finished goods plus minus opening stock of finished goods. No, I don't know how it is cost of production. That is one question which wherein I was stumped. Okay, anyway, if you can throw light on that, it would be good. Let's move on to the next one. Question number 88. Following information provided by B Limited. Okay, earnings per share, last earning per share of the company was 75 rupees. Fine. EPS is given. Then company's dividend payout ratio is given, that is how much dividend they are giving out of that earnings per share. Required rate of return from equity investment is 18%, fine. By using the capitalization earning method, the value of equity will be dash if dividend are expected to grow at a constant rate of 10%. Okay, again CAPM here, all that we need to do is just substitute the values in the formula, you will get the answer. Okay, first of all, let us try to identify how much is the dividend. See, earnings per share is given. How much is the earnings per share according to the problem itself? 75. But how much is the dividend then? So that is also given, because dividend per share we can easily identify by multiplying earnings per share into dividend payout ratio. So dividend payout ratio is 40%, 75 into 40%. That's all we have to do. So if I do this math, how much will I get? 30 rupees is the dividend which is being paid. Okay, fine, dividend is given. Now what is that we have to find out? Price. So price can be easily identified by using this formula, KE minus G. That's all. So now D1 is given 30 rupees. Cost of equity, somewhere they mentioned, no, 18% or 0.18, minus growth is 10% or 0.1. So when you do this math, you will get the answer. So 30 divided by 0.08. Let me do this. 30 divided by 0.08, which is did I go wrong anywhere? No, 375. Is that the answer? Is that the price, by the way? Yeah, option is there, 375. That's all. Fine, let's move on to the next one. That was question number 88. No, yeah, let's move on to question number 89. Once again, practical question. Oh my goodness, very good. 89. So they should ask more and more practical questions. That would make sense. But anyway, given the paucity of time, nothing much can be done. This is anyway the end of old scheme. As we know, the new scheme will be starting this December, where everything will be in descriptive nature. Thank goodness for that. So now P Limited has 12% debentures of 40 lakhs and 30% debentures of 60 lakhs. Two different things. Same type of capital, but different interest rate. That's all. If the corporate tax rate is 30%, then combined cost of debt after tax will be dash. Easy, because we know cost of debt is what? Cost of debt has a very simple formula, which is I into 1 minus T. Now we have to do the same thing for two different debentures. So now let me take up the first one, that is 12% debentures. Interest is 12%, so I will write 12 here, into 1 minus T. 1 minus tax rate they have given is 30%, so 0.3. So that will be 12 into 0.7. 12 sevens we know is 84, so 0.84 or 8.4%. 0.084, no? 12 into 0.7, yeah, 8.4%. Then that is for the 12% debentures. Now we'll have to look at the 13% debentures. Same exercise, because the formula doesn't change. Again, it is KD equals I into 1 minus T. So KD here will be I 13 into 1 minus 0.3. So 13 into 0.7. How much is 13 into 0.7? 9.1%. So we individually know after tax rate of 12% debentures, which is 8.4, and 13% debentures, which is 9.1. See, we know for a fact that even though the interest rate is 12% for debenture and 13% for other debenture, it is not exactly 12 or 13, but it is 8.4 and 9.1, because we have tax advantage. Because we pay the interest to the debenture holders, our tax liability will come down. Because of that, the interest rate will also come down. This would be the effective rate of interest which we will be actually paying to the debenture holders instead of the 12% or 13%. So effective rate of interest in this case would be 8.4, and effective rate of interest in this case would be 9.1%. So that is what we have found out. But that is not the ultimate answer, because what they have asked is the combined cost of debt after tax. So let's do that too. After doing all this, that is not so difficult. So 12% debentures and 13% debentures, two different things. How much is the total value? 40 lakhs here and 60 lakhs there, no? Yeah, 40 and 60 both put together 100 lakhs it is. So what is the percentage or weightage? So weightage would be here, it's very simple, 40% and 60%. What is the actual cost? 8.4, and here it is 9.1. So this is the cost of debt. So now weights into cost of debt will give us the weighted average cost of combined debt. So which would be 40 into 8.4%, which is 3.36, then 60 into 9.1 percentage, which is 5.46 plus 3.36 is 8.82. That would be the combined cost of debt, which is option C. If you have any doubts, please do ask. Okay, Hemant Bakchandani has a doubt. Just got my 12th result. I want to start the CS preparation. Please give me a roadmap. Doing it with BCom or BBA. Okay, all you have to do is take up CSEET exam and then start preparing for CSEET exam. It's a simple entrance test. It's not very difficult. So because the syllabus is not heavy, you can easily clear that. Once you clear that, you will be eligible to take up the executive. So you can do it with either BCom or BBA. Both are anyway useless. So depends on the college also. If it's a good university and a good college, then at least you'll be able to learn something. Otherwise, you can just do CS if you're confident of this, or you can even take up BCom or BBA through IGNO or something like that. That is what I would do if I were you, and if I had known about all these things, because I did my CS only after by BCom. I did not know about all these things earlier. Anyway, so regarding the roadmap, what I would suggest is please call one of us on the number given in the description. Maybe they would be able to explain to you in detail. Okay, please do that, Hemant. Okay, where were we? Question number 89, no? 90. Okay. Now, this again is a very easy question, nothing much to do here. Which of the following Ind AS deals with financial instruments presentation? Okay, so facts-based question, Ind AS 32. Now that I remember all these things, I also have to look it up, but you guys are supposed to remember all these things. As I said, when it comes to accounting standards, this is what they do. They will ask you which A standard stands for what. Which accounting standard stands for what. That's all. So in this case, Ind AS 32 deals with the presentation of financial instruments in the balance sheet. It sets out the principles for classifying financial instruments as liabilities or equity, and offsetting any financial assets and financial liabilities. AS 33 of course deals with the measurement of fair value. So it's a different thing. AS 113 is different. Ind AS 113, that is disclosure of fair value information. So that is about disclosure. And 109 deals with the measurement of financial instruments. Though they all talk about the financial instruments, it's different aspects. One talks about measurement of financial fair value. One talks about disclosure of fair value. Another talks about presentation of financial instruments. What is asked? Presentation of financial instruments. See, very tricky question, I would say, but still completely memory based. Moving on. Question number 91. Okay, practical question. Good. Following information is provided by A Limited, 2 lakh, 8% preference shares of 100 each, fully paid 200 rupees in lakhs. Okay, 60 lakhs equity shares of rupees 10 each. Okay, reserves and surplus, external liabilities. Average profit after tax is given. The normal rate or the return earned on the market value of fully paid up equity shares of the same type of company is 15%. Fine. Assume that 2% of the total assets are worthless. The intrinsic value per equity share. Okay, very simple question. Though the question is lengthy, it is not so when it comes to solution. See, intrinsic value per share of equity share. So it's very simple. Shareholders. Which shareholders, by the way? Equity shareholders funds divided by number of who are there? Equity shareholders. Equity shares actually. Shareholders funds. Now, which of these belongs to equity shareholders? Not all the shareholders. So equity shares of rupees 10 each, 600 lakhs and 270 lakhs of reserves and surplus, it belongs to the equity shareholders. So therefore shareholders funds here would be 870 lakhs divided by number of equity shares 60 lakhs. Since everything is in lakhs, we can simply write 60 here and be done with it. So if I do the math, 870 divided by 60, I will get 14.5. Option A, one share is worth, or its intrinsic value would be 14.5. I hope it makes sense. Easy question. Next, 92. Which of the following is not a method used for valuation of shares? Net assets method, definitely a popular method. Based on dividend rate, yes. Based on earnings also, yes. Net realizable value method, there is no such thing. So is not a method used for valuation of shares. So therefore answer is easy here. Next, again valuation, no? Which of the following method of valuation of shares is or are sustainable for ascertaining the market value of shares which are quoted on a recognized stock exchange? Market value. Okay, based on rate of dividend, based on rate of earnings, price to earnings ratio. See here, this is where we look into market. No, all of the above definitely not. The answer here is C. See, see, you can still use market based dividend method and earnings method also, but ideally option C would be better than the other methods given. Like if at all they ask which of the following methods is better, okay, that's what they've asked. Suitable, no? Okay, we can simply say C. Other methods can also be used, by the way. It's not that we can't use, but what we have to remember is no single method of valuation is universally superior in all circumstances. Different methods will have their own strengths and weaknesses, and which is most appropriate depends on various factors, including maybe the industry, company specific characteristic, investor preference. All those things will come into picture. Okay. Anyway, that is with respect to question number 93. Let's move on to the next one, which is a practical question. Okay. Average profit, super profit, capital employed of a firm are 15 lakh 60, 4 lakh 80, 90 lakhs respectively. Okay. Immediately we will note that it is a goodwill based question. Normal rate of return is 12%. The value of goodwill on the basis of capitalization of average profit and of super profit will be dash. Okay, they have asked two things. What? Capitalization of average profits, capitalization of super profits. If you calculate both, you will easily be able to identify the answer. So goodwill according to capitalization of average profits is nothing but average profits divided by normal rate of return into 100 minus the capital employed. Done. So now how much is the average profits according to the question? It is 15 lakh 60,000. 15 lakh 60,000. I'm just plugging the values in the formula. Divided by normal rate of return 12% minus how much is the capital employed? 90 lakhs. Okay. So now 1560 divided by 12% will be 1 crore 30 lakhs, is it? Yeah. Minus 90 lakhs, which will be 40 lakhs. So the goodwill according to this method, that is average profits capitalization method, is 40 lakhs. Okay. In the exam, you can actually do one thing to save time. So they have asked capitalization of average profit and super profit. Now there are various options. 130, 40, 187, 57, 130, 1137, 40 and 40. So first is what? Average profit. So now average profit, we know for a fact it is 40 lakhs. Which option has 40 lakhs in the first part? Option D only. If I were you, I wouldn't even calculate the next part. I would simply select option D and proceed further to save time. But still, we'll do that now. Capitalization of super profits method. So just to confirm, we'll try this. So according to this, goodwill will be super profits divided by capitalization rate. Super profit by capitalization rate, or normal rate of return into 100. Super profit is how much according to the problem? 4 lakh 80,000. So 4 lakh 80,000 divided by 12%. So when you do this, super profit is 4 lakh 80, no? Yeah, 4 lakh 80. So how much will you get? I think it's 40 lakhs only, no? Yeah, 48 by 12 is 4 anyway. So divided by 12%, 40 lakhs. That's all. Nothing much. Everything was given. All that we need to do was, had to do was just plug the values. So 40 and 40 is in fact the right answer. I hope it is clear. Let's move on to the next one. 94, 95. Oh, it's almost done now. Yeah. Next, as per section 247 of the Companies Act 2013, the registered valuer shall be appointed by dash. Registered valuer according to 247. Again, as I said, I keep saying this, CMA has a lot to do with company law, so it is better that you study company law simultaneously, even though they are of different modules. Okay, the correct answer in this case is Companies Audit Committee. Okay, according to this section, that is 247 of the Companies Act, the registered valuer shall be appointed by Companies Audit Committee. The Audit Committee is what? The committee of board of directors, no? Who are responsible for what? Overseeing the company's financial reporting and also the auditing process. And they are also responsible for appointing a registered valuer who will be responsible for valuing the company's assets and liabilities. So That is about section 247. Next, the risk-free rate is 8% CAPM. Return on broad market index is 15%. Fine, that is market returns. The actual return provided by the security is 18%. Oh, they have given the actual return also. What must be its beta? Okay, fine. Expected return would be RF plus beta into RM minus RF. Expected return is anyway given, actual return 18%, RF is also given 8 plus beta we do not know, RM is 15 minus 8. So if I take this 8 to LHS, it will be minus 8, so therefore 18 minus 8 would be 10, plus beta into 15 minus 8 would be 7. Okay, so therefore beta would be 10 by 7. How much is this? 10 divided by 7 would be 1.43 rounded off. So answer A is the right answer. It will hardly take few seconds in the exam. Easy. Management accounting part is actually easy compared to what is that the other part. Okay, next. The relationship between risk and return established by the security market line is called we just now did the same thing, no? It's called capital asset pricing model. Okay, what does it do? It's a model that describes the relationship between risk and return for securities. It is based on an assumption, by the way, that investors are risk averse. That means they do not like risk, and that they will only take on additional risk if they are compensated with additional risk. Higher the risk, higher the return. That is what we have been fed, no? So only then I will take up the higher risk. Otherwise, why would I take risk? Okay, I would rather invest in something else which is less risky and where I will get medium or average returns. So which method do we use, or which model do we use? CAPM, that is capital asset pricing model. Okay, then let's move on to the next one. Last 2-3 questions, that's all. Following are the details of beta limited. Okay, what details have they given? Equity share capital, preference share capital, debentures, profit before interest and tax, dividend payout ratio, price earning ratio, corporate tax. Earnings per share will be how much? Okay, what is earnings per share? The amount of profits which is available for equity shareholder. That's all. Okay, let's see. First of all, we'll start with profit before interest. Okay, profit before interest and taxes 590. Everything is in lakhs anyway. Less interest at 12% on debentures. On debentures means 12% on 250. How much is that? 250 into 12 percentage. What did I do? 50 into 12 percentage. 30. 560, which will be profit before tax. Now tax rate is given, corporate tax less tax at 30%. Okay, so 560 into 30 will be 168 minus 560 will be 392 profit after tax. This is obviously not available for equity shareholders because we have preference share capital for whom we have to pay preference dividend. 8% it is 4 into 8 32 less preference dividend. 400 is the preference share capital, at 8% will be 32 lakhs. So 360 is what is available to equity shareholder. We can call this as profit available to equity shareholders. Now it is easy to identify EPS, which is nothing but 360 divided by number of equity shares, which is 150. How do we know 150? Because 1500 lakhs is the equity share capital, divided by 10 rupees will give us the number of equity shares in lakhs, which is 150. So this is roughly around 2, no? 360 by 150 will be 2.4. Fine. 2.4 is in fact the right answer, option D. Okay, penultimate question, match the following. Fine. Okay, here we have to mention which are the direct costs and which are the indirect cost. Okay, raw material direct Raw material, we'll have to purchase raw material, directly related production related expenses. Showroom expenses, not an direct cost, it will be an indirect cost. So this is A, this is B. Drawing office expenses, indirect cost. Carriage inwards, direct cost. Carriage outwards, indirect cost. Primary packing, it is actually, or preliminary packing, I don't know, I think it is primary packing. So this will be a direct cost. Productive wages will also be a direct cost. Oil and grease, I don't know, can be considered direct, maybe indirect. Let's see, let's look at the options actually. A, 1, 4, 6 and 1, 4, 6 and productive wages 7. Correct. Okay, my guess is correct. Oil and grease is indirect according to them. So this will be showroom expenses B, drawing and office expenses 3, carriage outwards, and finally oil and grease. Option A is in fact the right answer. Okay, last question of the day. Let's quickly look at it. What is this? According to behavioral analysis, but it's always difficult to pronounce this one. The overheads may be classified as what? Based on behavior. See, factory overhead, administration overhead, these are all not behaviors. Behavior would be fixed overhead, variable overhead, and semi-variable. This is actually easy if you know the concept beforehand. So behavioral analysis is a study of how costs change in relation to the changes in activity levels. Okay, so where does it change? Even in this type of cost, that is fixed overhead, variable overhead, and semi-variable. Okay, it is again important for managerial decision making. So that's what we do. That's all. That's about CMA question paper December 2019. We have solved the entire question paper, though it took us some time. So in the next class, what I will probably do is I will only concentrate on the practical problems, ignoring the theory. Theory, I think we have covered so far in detail. No need to do the same thing again. I think next week we have one live session on CMA. We'll see. Thank you. See you again sometime this week for a live session on FM. I think most likely on Thursday. Oh no, tomorrow is Thursday, no? Friday, I guess. Fine guys, thank you. Bye bye. See you. If at all you have any doubts, please leave a comment below as usual.